Schedule B is interest in ordinary income. Um, uh, Typically, if you're getting it from a brokerage house, they give you what you need. They give you a little pamphlet put together, and the pamphlet has got the interest that's um, classified as foreign interest, and ordinary interest, and taxable interest, and non-taxable interest, etc. So it's a matter of if you've got it off from brokerage houses, relatively simple. If you're getting interest, say, from a brother-in-law or um, something along that line, it makes it a little bit more complicated because you got to fill in who it is and why. I might note that if it's from a relative that you're getting the interest, one of the things the government looks at to see if the interest is a reasonable interest. In other words, is the fair market value being used for determining the interest rate? So let's say the interest rate is 6% and you're charging 2%, you're probably going to have an imputed interest of 4% income to you. And the individual paying it, however, does not get to deduct the imputed interest, only the recipient. So that I've had happen to my clients a couple of times. And each of the situations is because they had a child, and that child, quite candidly, took up a lot of the money, and they bought the down payment for the house for the child, they paid for the child's car, and so finally the parents say, okay, we got to stop this, we're going to start charging you interest. Well, they did not charge the fair market value of interest that you would pay in the market. They gave them an extremely low interest, which probably didn't hurt the child at all. The child probably didn't learn any lesson on it, and the parents wound up paying imputed taxes. So that's something to worry about. I always check the forms that I get from the brokerage houses to make sure there's no obvious errors. I guess the government has to do the same thing I do to see that the inventory, the dividends, is the same. For example, when I look at what stock they were getting dividends on last year and interest and where it is today, and if they don't have it, ask them if they sold it or if they bought new ones. That'll also impact what we have today. Next one, Schedule C, profit or loss from sole proprietorship. Probably the most frustrating thing I do in taxes, and I've done corporate taxes, S corp, partnership, trust, estate tax, gift tax, you name it, is sole proprietors. For some reason, the sole proprietor cannot separate in their accounting and in their mind their personal expenditures from their business expenditures, which means a lot of time I have to, when I deal with a client with a Schedule C, I have to spend a lot of time redoing their paperwork. I don't bother doing a full new ledger and everything. I make manual adjustments to what they have. But I've seen where people put in education of the children, goes into the cost. We have a school here called Oaks Christian, which is a private high school, middle school. Tuition's approximately $20,000 a year, and one of my clients thought it was valid to include the tuition in his deductions from his business because it was an expense he was incurring. That was, he said, business expense, because this way I didn't have to worry about what my kids were doing the day. I knew exactly what they were doing. Well, that doesn't work that way. I had people buy a new refrigerator, put the refrigerator in on the expenses. Refrigerators for home. Now, if they bought the refrigerator for their office, that's something else. Office use used to be very complicated if it was a home office. Today, the IRS has a formula which makes it very simple. And the nice thing about that is we used to get audited every time we put in anything for a home office. Today, with this formula, it doesn't use as much as probably it would be if you use actuals, but it prevents that audit, which tends to be really complicated and ties up a lot of time. Now, the best thing to do is have the sole proprietor have a bookkeeper do their bookkeeping for them, not their spouse and not them, because quite honestly, they don't do a very good job at it. And if they do a double entry, and bookkeeping by the bookkeeper, and they use an accrual basis. Now, actual can be used for certain purposes, but the accrual is best for preparing your taxes. It seems every time someone had an actual accounting system because they did only services and they didn't require to have a hybrid or any other type of, they could just use the cash, we had problems with the IRS. And there's no sense inviting the IRS in for problems. And when it's just as easy for the client to establish an accrual-based accounting. Plus, if the company was going to be sold, or she has to borrow money, they really need an accrual basis to be able to accomplish all of that. And the people just forget about all those needs for those accomplishments. Let's see, we could spend probably an hour just on the Schedule C, but we'll cut it off with just these comments. To be a business, and this is the part that sometimes gets the clients, where I get clients rather, primary purpose is making a profit, not a hobby. Jerry goes in and he refurbishes furniture at night, and he gets called in on an audit, and he's making, we'll say, $20,000 to $25,000 gross on his furniture refurbishment. But the first couple of years, he spent a lot of money in advertising, and he had a loss the first 2 years. And he puts in as a Schedule C. He gets called in by the company. He said, I can't believe this. It's a part-time job. The time passes so fast. I'm having so much fun refurbishing the furniture. And the IRS treats it as what's called a hobby loss, which means you cannot take losses for that business. So that's a concern I have when clients talk to the IRS. My rule is that the client never talks directly to the IRS. They have an accountant, a lawyer, enrolled agent, someone to represent them who know what they're talking about, and they keep their mouth shut. In fact, there are times I don't allow clients even go to the IRS with us because they tend to open their mouth and say the wrong thing. And the point is, if you're doing something other than making a profit as your main goal, and you have a loss, you're not going to be able to take advantage of that loss. And for new companies starting out, losses are common. I don't know if it's 2 years or 3 years the average company spends before it makes its first profit. In case of Amazon, it was probably 10 or 15 years. Doesn't mean it's not trying to make a profit. It just takes a while to make a profit. And that's certainly here. Second thing that I didn't put on here is the starting date of the business. It's not when you decide I'm going to have a business, or not when you get a business license, at least, it's when you make your first sale. All the expenses up till then are organizational expenses. So you got to keep track of the first sale. And I used to tell people, get your mother to buy something from you on a fair market value. In other words, arm's length transaction with your mother, same as you would somebody else, to get that business off the ground, rather than having it sit there for 2 months where you're still trying to get your inventory stored away, etc. And once you make that first sale, now it is a business and starts to be deductible. Until then, it's just going to be something that's amortized over 15 years. Second thing, it's got to be involved with business with continuity and regularity on the part of the owners. If you're not involved with continuity and regularity, it is not going to be deductible for purposes of any losses. And again, new business starting off, losses are extremely common, and you have to document your time. You just can't say, well, I spent 20 hours a week on it. You have to be able to document to the IRS your time on it. One of the things, for example, you might have a little diary book where you each day record what you're doing. You might have it on your computer, which has all sorts of gimmicks you can have for keeping track of your time. Main thing is being able to account for it. And it's got to be reasonable. I had one lady who was trying to convince the IRS that she was a half-time, so I believe it was 750 hours she spent a year doing residential management of her apartment houses. and she had 3 apartment houses, and I believe 1 or 2 private homes that she had, and she would try to get that as a deduction on her losses, because if you're over the 500 hours or 750 hours, whatever it is, it's all deductible. There's no limit on the deduction. And so she had her book, and she'd say, went to the bank, hour and a half. Well, she put down, she went to the bank at 10, got it home from the bank at 11:30, and she did this. Everything was kind of stretched as far as reasonableness. Like, we have to get to 500 or 750 hours, therefore, what do I have to do to get there? And the IRS just took an arbitrary, she was arbitrary, they thought, so they took an arbitrary also, and found she did not have enough hours. And third, in income cases, multiplied business can, in some, it should say some, I'm sorry, it should say in some cases, multiple businesses can be combined to overcome the passive loss rules. And I've had clients who own a gas station, a liquor store, dry cleaner, bowling alley, movie theater, completely unrelated. But they were able to show it was really one business for tax purposes, because usually when you own 5 or 6 businesses, one reason you own it is for diversification, so that the profit making offset the ones that are not profit making. And therefore, quite candidly, if you aren't able to show the offset, you're going to have losses that you got to carry over, and the losses carry over until it makes a profit, or you sell the particular business. And if you die with that business and the losses, you have a very limited loss. You lose most of your losses. So I encourage the clients whenever possible to work it so they can show that their businesses all are related. And how you do that is common ownership, common types of products. For example, if I'm a wholesaler grocery store and a retail grocery store I have, that's obvious they're related. If I'm a liquor store and say a dry cleaner, that becomes more difficult. Then maybe I use the same accounting person. I keep the books together. I use common, share the advertising expenses, etc. There's a whole bunch of things that your accountant can tell you what to do, or if you, as an advisor to your clients, you can have the clients do, that are found throughout the internet, and even the IRS has some good information in that area. Next one is Schedule D, capital gains and losses. This one, people for some reason are shocked that they have to pay taxes on capital gains, and I've never figured out why, but they feel that that's something it's not income, it's capital gains. Well, the IRS decided that capital gains are income, so what are you going to do? Again, you have to find in the IRS where it's excluded if you want to keep it from income. And here, this is usually when you're selling an investment, or selling real estate, or selling property that's a capital asset. There's short term and there's long term. So it's important you know the date you got it, what you bought it for, what you sold it for. That's sometimes the hardest part. I've had people who have come in, bought stock 20 years ago, they finally got rid of the stock today. What was their basis? They had no idea at all. So we'd have to, if it was big enough, we're talking hundreds of thousands of dollars, we'd hire a forensic accountant to come up with something. If we couldn't find a forensic accountant, we'd come up with a guesstimate, like it was probably in 1964 that they bought it, 65, and so we look at what the price of the stock were then and come up with an estimate. Sometimes it works with the IRS. IRS has never put it at zero, but they put it very close to zero on their calculations. So if you didn't keep record of it, and again, this is one of those examples where I tell clients, and you should be telling your clients, tax data should be retained. If it relates to your tax forms in any way, retain it. And if it relates to sale or purchase of any capital type asset, be it a residence or stocks and bonds or artwork, you got to keep those records indefinitely. I've had clients who My worst case was a client who bought real estate in Hawaii in 1947. He was in his 90s when he died. We had no record of the transaction. Neither he or his sister, who also bought it, kept a copy of anything. We found a deed, but how it was paid for was not kept. So that any type of bank records, contract agreements, etc., should be retained, and it usually comes up in Schedule D, the capital gains and losses area. Remember, you can only take up to $3,000 of losses a year. Unless it's against gains, I can offset losses versus gains, but if I don't have enough gains, then the losses of $3,000 maximum a year. And if I have too many losses, like I had a client with Sun Micro stock, he had over $1 million worth of it. It went down to like $50,000 on him. That loss, he'll never be able to make up because he's never going to have enough income to offset it. When he dies, it's a loss, a substantial loss that he hasn't taken advantage of. And therefore, what I tell clients is, getting older, best to do is get those assets that are in a loss position out of you by selling them. Makes a lot of sense to sell them, quite candidly, because once they're sold, they're no longer your responsibility. And that is what I was trying to have people do when they're thinking about what about to do with my losses, is get rid of them. Unless you can offset them, but many times you can't offset it, then just get rid of it. You can't take it with you, and it doesn't help you for your estate tax. Schedule E is supplemental income and losses. This is when most clients come in, have this zero filled out on anything. I said, did you help anybody during the year? Nope. Did you work for anybody during the year other than your regular employer? Nope. Did you sell anything during the year? Nope. And then we get into a little bit of conversation. He says at nights he's all tied up at night because at night he's been working part-time in a bar, stocking the bar or stocking the grocery store on a moonlight job in which he does under the table. Well, I said, well, even though it's under the table, you should be reporting that income. Now, I can't force them to do it, but they should report it for their own safety. I don't care about the employer who's doing it on the table, but they should report it. Likewise, if they do any consulting work, and let's say you're a broker and somebody says, I'll pay you $500 if you do a financial plan for me, or $5,000, it doesn't matter the value. But you don't do a financial plan ordinarily, you're just doing it because the client asked for it. It's not part of your brokerage, you're not going to get paid from the brokerage also, you're going to be paid by the client. That goes on this supplemental income and loss. You have an asset that you own, that you make a profit on the asset when you sold it. That goes on this sheet. So, and that's usually, I'm trying to think of things right now that I've run into. One person had a classic car. He had a Mustang that he bought in the 1960s for $1,600 or $1,500, and he sold it when it was like $40,000 or $50,000 a few years ago, because it was a classic. And I said, did you keep records of the upgrades you did and refurbishments? No. Now, if he had, that would have reduced the amount of gain he would have made on it, but he didn't. Likewise, on sale of residence, there are certain advantages today where if you hold it for 2 years, you owned it for 2 years and lived in it for 2 years of the last 5, you get this big deduction, $250,000 that's tax-free on the gain. But, well, many people don't stay there that long, and they buy a house, they decide they don't like the neighborhood, they move out 3 months later, 6 months later. You're going to have gain or losses there, and they're declared here. So there's a lot of little things that show up here that should be included. A lot of people don't even think about, like the sale of the antique car, or a sale of some jewelry. I had a client who had some jewelry that came from the Russian Tsarist from 1850 or something, that she inherited. Her mother, her great-great-grandmother or grandfather worked for the Tsarist and got this jewelry, and she sold it because she was retiring and needed an income for retirement, so she sold it. She sold it for $300,000. Well, the question was, what was her basis? And again, basis becomes very important when we're dealing with Schedule E. And basis, very simply, is what is the value it was when you received it. And that value can be different for estate tax. If you receive an inheritance, it's the fair market value date of death. If it's a gift, it's generally, but not always, the fair market value at date of gift, or the basis, whichever is lower, of the donor. If you find something, the basis is 0. And I might note that for those of you who have some clients with small businesses where a local government gave the property for them to use, I know in some cities where there's vacant warehouse buildings that are being used by people today for purposes of the starting small businesses in these old warehouses, and the city just gives them the property. The basis of that property is 0. So not uncommon to see a 0 for a basis of an asset. And you really have to find out from the client where they got it from and their documentation. Again, everything in taxes is concerned with documentation. I don't think we impress that enough in people taking courses in documentation and taxation, but documentation is the most important thing. Schedule E, and I talked about some of these. Real estate is a good example. Royalties, partnerships, S-corps, estates, trust. This is going to be that Schedule E income we talked about on the previous chart. F is profits or loss from farming. This is a very specialized field, and I can honestly say that I have never done it of farming or fishing tax return, because they are so different, and for me, it was not worth the time for me to value to learn it, because it is very time consuming. But certainly someone who lives in the Great Plains or San Joaquin Valley or even Ventura County where I live, that might be a good occupation of doing tax returns for farming. That includes gentleman farmers, by the way, farmers which basically are not really farmers, but they're called farmers. Schedule H is a household employment tax. This I emphasize with my clients when they're thinking of things such as getting a security clearance, or they hold a security clearance with the federal government, if they want to get a state job, if they want to get elected office. Along this line, be very careful that if you have household employees, you're meeting all the household employment tax. I realize a lot of people don't. We've had cases where people who were going to be Secretary of Labor lost the job because they found in the past they didn't pay for the nanny tax. And so housekeepers, babysitters, gardeners, whoever is a household employee who meets the minimum, you have to have Social Security tax in some cases, Medicare taxes. Again, this all depends on the dollar value they're earning, what is withheld, etc., and what type of situation's in. So again, I try to make sure that I understand. In fact, I'll say, well, who cleans your house? You and your husband? You got your husband doing it? She's on, I have one coming every week. I said, we really should be declaring that on the income, because if something comes up later, the penalties are severe, and it's a lot easier to pay the tax than paying the penalties and interest later on. With many times penalties and interest are substantially greater than the value of the original tax. And I said, in today's environment, that maid or gardener might just decide to get some income by telling on all the people they work for. And in summary, we've talked about tax form 1040 and some of the schedules that you run into. I forgot sorry, we missed this one. Schedule SE, self-employment tax. This is when you are self-employed. In other words, a sole proprietor should be filling this out. And even though you may have a loss, you still should fill out the form so that it's documented what you're doing. The form is fairly straightforward. It looks more complicated than it is. It's kind of logical if you think about it. Now we're back to summaries, and we covered these forms. We did not cover 10EZ or 10A, which are the 1040A, 1040EZ, because again, they're under 100,000 where they don't have any real expenses. Some people actually do it by phone call, and it's done on the internet for free. So since people are getting it for free, I advise clients who are earning, say, 60,000 in wages, they maybe have 1,000 in the interest, to just go online and have the free service done for them. Also, if they're older or they're poor, there are people who are employed by the federal government to help service them in filling out their tax returns. And I actually, one year I spent helping for elderly people over 55 who needed help with their taxes. An individual had earned $300,000 in interest and dividends and wanted to get a free tax return filled out. And I just felt that was going a little overboard. So I told him, I'm sorry, it's beyond the level that we're threshold we are allowed to take here. And he complained a little bit, but he went off and got it done. And it's probably better, quite honestly, because we, in doing mass production, we weren't trying to get it right, we were trying to get it out and save the client from, in most cases, they paid zero or such a nominal amount it wasn't worth the government even having to fill out the tax return. So when you talk about 300,000 income, that's a different issue. Well, we covered a lot of information here, and I think if anything else I want you to run away with is first of all, documentation, very important. Second, you have to ask the client questions, even such things as their social security number and their current address isn't always correct. Their name isn't even correct in many cases. People get married, divorced, and people change their name. I had a client with the name, and I mispronounced it, but I'll try, Zhakowski, and he changed his name after about 5 years of being in the workforce. He said he made it a lot simpler in his life by just changing the name last name to George. Well, he had to change that on a Social Security form. Again, Social Security forms for name changes, and then the IRS gets changes for addresses. And with that, I'm going to say best wishes and good luck.